All right, well, welcome to Chapter 5, where we'll talk about the corporate side, looking at contributed capital and dividends. In this chapter, we will look at public versus private corporations. We'll talk about how to account for various components of shareholders' equity, what it means to issue share, dividends, obviously income tax expense in the corporate world, so a new term that you did not learn in Accounting 1100, and then how to calculate retained earnings. So corporations are a separate legal entity from its owners. So its owners typically own a piece of the organization, otherwise known as shareholders. And the reason why we use the word shareholders is because they hold shares of equity in the corporation. So they hold those shares. As I said, they are a separate legal entity. They have limited liabilities, being shareholders. There's an unlimited life of the corporation in theory, and they have an ability to raise capital. On the right-hand side of the screen, you'll see that the equity section then does look a little different. In a sole proprietorship, they have owner's equity and capital. Partnership, each partner has their own capital account with a partner's equity. And in a corporation, shareholders' equity typically includes common shares and retained earnings. And they might have preferred shares, which we'll talk about as well today. Some of the characteristics of different business organizations are tabled below, where we look at how many owners are in these different types of organizations. And in a corporation, there's typically one or more shareholder. It can be a single shareholder of a corporation. The owner's liability for those shareholders is limited. Its life of the business is unlimited compared to in a partnership or sole proprietorship. When those persons pass away, it dissolves or they leave. Otherwise, in a corporation, it gets passed on, through estates or through market sales, whatever that might be. Where the earnings are taxed in a sole proprietor and partnership being on their personal tax rate, it is taxed at a corporation, or corporate tax rate is set by the CRA, Canada Revenue Agency. And some examples might be a sole proprietorship being Indra's Bookkeeping Services, limited liability, perhaps a PricewaterhouseCoopers for a partnership, or General Electric, who issues shares in their said corporation. For an organization, typically when you create the corporation, any initial costs, those organizational expenses, are typically inclusive of incorporation fees, maybe lawyer fees, taxes to create the corporation, any licensing. And those costs are typically debited to an expense account that we call organization expenses when you first set up the corporate entity. Now, you may recall in Accounting 1100, we introduced IFRS and ASPE, so being the International Financial Reporting Standards, or the accounting standards for private enterprises. All publicly traded corporations, so if you plan to trade your shares on a stock exchange somewhere in the world, you would have to adopt IFRS standards. However, if you're a private corporation, you can follow IFRS, or you can choose ASPE for private organizations. It does require fewer disclosures than IFRS, and IFRS can be more technically complex as far as additional reporting and disclosure requirements. Looking at the accounting for shareholders' equity, typically the articles of incorporation will dictate to the reader how many shares that a corporation is authorized to sell. And those are always disclosed as the authorized share. So they might create a corporate entity that says they can issue 100,000 shares. However, when they are authorized, they become issued shares. So they might be authorized to issue 100,000 shares. They might only choose to issue 1,000 or 10,000 shares at a time. And the issued shares will be itemized. Outstanding shares are shares that have been authorized and issued and have been purchased by a shareholder. Okay, so they're being held by a shareholder. There is a large secondary market for shares where they're sold on the market, and that's determined, and it results in a market price. So the market value is determined, how much are investors willing to pay for those said shares. That, goes up and down on for various reasons. There are different classes of shares. We talked about common shares or preferred shares a moment ago. So common shares, you actually become a partial owner of the company. So common shares has voting rights when it comes to various company matters. So say there are 1,000 shareholders and 1,000 common shares. So each of you have one common share. You'd have 1/1000th of a vote in any key decision. When it comes to preferred shares, they're a little different in that they receive preference because dividends have to be paid on them before any common shares. And the preference does not guarantee that dividends will be paid though. And I'll say very often, actually, I've yet to see a spot, but preferred shares are typically non-voting. Now, there are preferred shares that are cumulative versus non-cumulative. So cumulative means it gives the shareholders the right to be paid both the current year's dividends plus any dividends owed for past years before the common shareholders get anything. Non-cumulative means you have the right to get the current preferred shares being issued, but not perhaps any unpaid dividends from prior periods. Dividend entitlement, preferred shares can be either participating or non-participating, where participating preferred shares allow them access to any excess in the dividend account over and above what the preferred share minimum are. Okay, so say there's an 8% preferred dividend. Once that 8% is paid and there's some value left in the dividends declared, it gets shared to participating preferred shares and the common shares at that point. Non-participating is where it limits as far as what can be issued to preferred shares holders each year, and it's based on what's stipulated in that issuance, which in my previous example might be, say, % of the value. Often, there are what we call par value and non-par value, so where shares are listed as par value, which means there's always a set price. Non-par value means there's no assigned value. And throughout our examples today and in most of the exercises, I believe they're all no par value. I'll take a look and I'll give you an indication if they are issued at par, but it'll say so if that's the case. Now let's go through an example. So a corporate entity on April 10th, 2020 issues 20,000 common shares for $20 a share in order to generate $400,000 cash. In order to record this journal entry, we will have a debit to cash, increasing the value of our cash by $400,000, and a credit to our common shares account, which shows up in the equity section. We will describe this as to record the issuance of 20,000 common shares at $20 per share. And you'll see on the balance sheet, it impacts cash and the equity section. And that shows up under the contributed capital section, which then has common shares and preferred shares, perhaps. Let's roll forward and say on September 30th, the corporation issues 30,000 preferred shares for $10 each. So they've raised cash of 300,000, and now they have preferred shares, which becomes part of contributed capital as a credit of 300,000 for those 30,000 shares at $10 each. All right, so let's assume an example where they don't actually get cash, but they get some kind of asset. So in this example, the corporation issues 20,000 common shares at $40 a share for equipment. So they're given equipment, but they don't really know what the fair value. Therefore, the company would assume that the fair value is based on the market value of the shares. So we take the 20,000 times the $40 to say that the equipment is worth 800,000. Our equipment would be debited for 800,000, being under the long-term asset section on our balance sheet, and the common shares would be credited for that set amount of 800,000. Another example, what if they issue 1,000 shares of no par value common shares in exchange for land appraised at $1 million? They would debit the land $1 million and common shares $4 million. And the note would be 1,000 common shares for land worth $1 million. So those are quite some expensive common shares, $1,000 a piece. And again, on the balance sheet, our capital, our PPE section goes up $1 million, and our equity contributed capital goes up $1 million. Now, what if we issue it for exchange for services? So we have an example here. We have a new corporation that requires the services of an accountant, and the value of those services is $10,000. We offer them 1,000 no par common value shares at the current market value of $10. In this situation, you have to describe what was the issuance of shares for. So here we have an accounting fees expense that will be debited because we traded shares in our company for that accounting. So accounting fees expense would be debited $10,000. Common shares would be credited for $10,000, and that's to record the issue of 1,000 common shares in exchange for those services. See it on our statements here. It'll hit shareholders' equity, but then it hits our operating expenses on the income statement. All right, let's move on to some dividends. Typically, there are two different methods, and on the date of declaration, you can either use the cash dividends account or use the retained earnings account. So in this situation, we have they've declared a dividend of $1 per share, and it's to be paid on all 10,000 outstanding common shares. So using that cash dividends account, we will debit the cash dividends common, which is a negative equity, and then credit dividends payable, which is a liability. Using the direct retained earnings account, we would debit the retained earnings and credit dividends payable. So at the end of the day, it's still sitting as a liability until it's paid to those common shareholders. In either case, cash dividends common or retained earnings being debited will reduce the value of the equity in the organization. Oh, sorry, one other thing to point out is on the date of record. So if we declare dividends today that says on the date of record being March 31st, 2020, perhaps, the corporation would need to get a list of all the shareholders, okay, and the number of shares that they each earn in order to record who will get those dividends when they pay it out. So how do we account for cash dividends? So let's give an example. On June 30th, 2020, the corporation then pays those dividends declared on March 31st, and we would then debit the dividends payable because they've paid off that liability and credit cash accordingly for the $10,000 declared. Now, what happens if we have dividends in arrears? So we have this balance sheet for this company as of December 31st, 2020, and we're showing the shareholders' equity section. We're showing that there are preferred shares with a $2 cumulative, $6 par value, 15,000 of them authorized, 10,000 are issued and outstanding, and they're worth $60,000 then. We have preferred shares, $2 non-cumulative dividends, 30 authorized, 25 issued, so 25 times the fact that we must have raised $4 a share gives us $100,000 because they have no par value. Common shares, unlimited shares authorized, 100,000 shares issued, worth $200,000. Okay. So as of December 31st, 2020, let's assume that there were 0 dividends declared. And for the year ended December 31st, 2021, dividends declared were 100,000. They would disclose that accordingly. So in the contributed capital section, actually, sorry, I got a cough, 2 seconds. All right, so here we are. So in this example then, if they declare dividends in 2021 of $100,000, they would have to look and say, are there any cumulative preferred shares? So first of all, they'd have to take the first preferred shares for the current year, $2 and $2. So the first 2 times 10,000 and 2 times 25,000 is $70,000 of this 100 has to go to those preferred shares for the current year. Then they would say, okay, are there any other past dividends owing? And in this example, we have preferred shares $2 cumulative, so we have 20,000 owing from the previous year. So we would owe another 20,000 to these preferred shareholders. So that takes up 90. So we have $10,000 left, which then, assuming these are non-participating preferred shares, would be given to the common shareholders. $10,000 over 100,000 shares, they would each get 10 cents per share. All right, so accounting for cash dividends. Actually, this is that example. I forgot they had a slide. So here we go. The corporations must track what's owing. So what I just said a moment ago, the cumulative preferred shares, 20,000 for 2020, 20,000 for 2021. Then the that totals the 40,000. The non-cumulative is $2 times 20,000 is the 50, totaling 90, leaving 10,000 to be paid to the common shareholders. Now, to record this declaration of dividends on December 15th, when the date of declaration, we would then have 3 different debits being to the different dividends account, one for preferred cumulative, non-cumulative, and common shares. They'd be debited for the value as per the previous table of 40,000, 50,000, 10,000, for a total credit to the dividends payable account, the liability to pay at a future date, of $100,000. So now, if say they roll forward on February 10th, 2020, and they make the payment of the 100,000, then they would debit the dividends payable account for 100,000 and credit the cash for 100,000. So then it impacts the balance sheet in the asset and liability sections. All right, let's have an example of where we have stock splits or stock dividends. So a stock split is a decision where an organization decides to typically do a ratio, a 2-to-1, 3-to-1, whatever that might be for the stocks. It decreases the price per share, but does not change the number of shares being traded. So in this example, we have $1 million in total value for 10,000 shares at $100 market price. So let's say we do a 2-to-1 stock split. So therefore, we will double the number of shares. Anybody that holds 1 will now hold 2. The total value of those shares doesn't change, so it drives the market price down to $50 each. Let's do an example of this. Let's suppose that as of December 31st, there are 10,000 common shares outstanding with a $40 market price. The book value of the common shares on the balance sheet is $200,000. On January 15th, 2021, the company's board of directors declares a 2-for-1 stock split. The stock split results in twice as many shares, but at the same overall book value of $200,000. Each shareholder now owns 2 shares for every 1 that they originally held, but the market will respond by dropping the market value from 40 to 20. The overall result is that there'll be no change in the shareholders' percentage owned because it's the same pro rata relationship. So if we look at their balance sheet before and after stock split, the only difference, there's no difference in dollar values. The only difference is that 10,000 shares issued and outstanding now becomes 20,000 shares issued and outstanding. No change in the equity for this stock split. So sometimes they might issue a stock dividend. So instead of giving a cash dividend, a company might decide that it needs to keep its cash for various asset or investment reasons. And sometimes it's to help make to help keep the share price affordable for new investors. So let's have this an example on December 31st, 2020. This corporation has 10,000 outstanding common shares, and the current market price is $40 per share. So here we are. We've got their balance sheet before recording this example. Common shares, 10,000. They're worth 200,000 for when we issued. And we had retained earnings at $500,000 for a total equity of 700,000. Let's assume that they issue a stock dividend of a 20% on all 10,000 outstanding shares, and the market price was $40. So they need to calculate what's the true value of issuing that stock dividend. There are 10,000 shares. 20% dividend is 2,000 shares. Current market price is $40 per share. So we issue the value of 2,000 shares times $40 on the market is an $80,000 transaction. To record this activity, they need to debit their retained earnings because they're not giving up cash. They're giving up retained earnings in the company to those shareholders. So it's a 2-part entry. We will debit retained earnings and credit what we call common stock dividends distributable. So we will distribute them to the various shareholders. And then once we distribute the stocks to those shareholders, we will debit that distributable account and credit the common shares. So the shareholders equity section now, left-hand side was before, right-hand side is after. total shareholders' equity does not change, but you'll see that the $80,000 was removed from retained earnings and added to the value of common shares. You'll also see that the 10,000 number of shares in the pre-stock dividend is now 12,000. So 10,000 invested 200,000, 12,000 is now worth a $280,000 initial investment, including that stock dividend. So to do a little summary of the impact of cash dividends versus stock dividends or stock splits. If we have a cash dividend, it never changes the value of our common shares, doesn't change the quantity. It will decrease retained earnings because we're paying out money from retained earnings to our shareholders. Therefore, it decreases shareholders' equity. And it's a decrease in assets because we're using cash to pay those shareholders. In the stock dividend scenario, it will increase the value of our common shares because we're adding the current market value times the number of stock dividends or stocks issued in that dividend. Increase the value, increase in quantity. It'll decrease the retained earnings for that value. No change in overall shareholders' equity, and therefore no change in assets. Stock split, no change in value, but there is an increase in quantity. No change in retained earnings or equity or assets in that situation. All right, let's move on to income tax. A corporation always has to file an annual return for their activities, and they have to pay taxes on their net income. And the amount that they're obligated to pay is known as income tax, just like a person. So let's assume that for the month ended January 31st, 2020, this company reported net income before tax of $266,000. Let's assume the company is subject to an income tax of 30%. So if we take their income times 30%, we'll determine that they owe income tax of $79,800. And I just realized they have an error in this PowerPoint. It should be for the month ended January 31st, 2020, not 2018. Just like they have the date wrong here. This is messed up. Let's ignore the dates on here for a moment and focus on the journal and how they calculate. So it's the income times the income tax rate. So there will be an income tax expense incurred, which is at the bottom of the income statement. And there'll be a credit to the income tax payable because we didn't pay it the same day, we just calculated it. So we'll increase that liability by the same amount. Now, just like sole proprietorship or partnership where we need to close accounts to equity, we would do the same for the corporation. So at the end of the fiscal year, we would have to close off the revenue to the income summary, all the various expense accounts to the income summary, close out the income summary net amount to retain earnings, whether it's a deficit or a surplus. And then we need to close out any dividends declared that year to retain earnings. So any dividends declared will reduce retained earnings through the closing process. Now, one of the questions might be, how do we calculate retained earnings? So all share capital and retained earnings are reported separately in the shareholders' equity section. And the retained earnings statement shows the changes in retained earnings during the year. So let's show you an example where this company had a balance of $100,000 at the beginning of the year. They had net income of $40,000, but it also paid cash dividends to shareholders in the amount of $10,000 and stock dividends at a value of $5,000. So it'll be subtract the cash dividends of $10,000, the stock dividends of $5,000. So their closing retained earnings at the end of the fiscal year will be $125,000. So you'll have a statement like this for the retained earnings section. Last little demonstration here is the balance of retained earnings fits in the shareholders' equity section of the balance sheet. So we've got a partial balance sheet displayed here where we have contributed capital consisting of any shares that are outstanding and issued. So we have preferred shares of $12,000, common shares of 5 million, and the retained earnings of 125 is calculated by the other schedule. Total shareholders' equity in this little example is $5,137,000. And here we have a little test. We're given some detail on what is the value of retained earnings. So we're told net income, 300,000, retained earnings at the beginning of the year, 100,000, and dividends of 40. So thinking about the previous couple of slides, how would we calculate retained earnings? So here we would go retained earnings at the beginning of the year, plus the net income, subtract any dividends for the year, would give us a retained earnings for the year, which would result in $360,000. Now, any private corporation that follows IFRS, the detailed calculation of retained earnings must be included in a formal position in the changes in shareholders' equity. So they would spell out those moving components of retained earnings. So that kind of covers off this section for Chapter 5. Hopefully you found this helpful.